Good morning, friends. National Savings Certificate interest accrued. How to show this in our income tax returns by Rajendran Sivaramapillai, formerly advisor banking. And the disclaimer: I am neither an expert on income tax or tax audit nor authorized by IT department. This is based on purely my personal experience through e-portal of IT department and guidelines, and so please be guided by IT guidelines and latest amendments. Important guidelines on NSC investment. There is no maximum limit for investment under NSC, but investment up to rupees 1.5 lakhs as standalone can be claimed as deductions under section 80C in the year of investment, or in addition to other investments like PF, PPF, insurance premium, etc., subject to a maximum of rupees 1.5 lakh. Under the new regime, since deductions are not taken into consideration because the limit which is exempted from tax under the new tax regime is 7. The second important period is 5. If, for example, rupees 10,000 is invested in the year 25th March 2023, the matured amount along with accrued interest is payable on or after 25th March 2028. Example, let us consider at the rate of 7. Please verify the actual rate of interest as per your certificate. Now let us see how this accrued interest, how this comes. Suppose if 10,000 is invested on 25/3/2020, last financial year, that is 2022-20. During the year 2023-24, the first year the interest accrued is 7. During the second year, the interest accrued is 749 because the earlier interest of 700 is taken as reinvest. Similarly, in the second year, the interest of rupees 749 is added to the previous total, so it is 11,440. During the third year, it is 801. In the fourth year, the interest of 858 is added. Again, in the fifth year, 918 is considered as interest and the maturity amount is 14026. But this amount is not reinvestment. Now, reinvestment can be claimed under 80C subject to a maximum of 1.5 lakhs or actual amount in the year invested. This means one can invest even more than 1 lakhs. There is no upper limit. So even people can invest 10 lakhs or 20 lakhs or 30 lakhs as the case. But for the purpose of IT deduction, only rupees 1.5 lakhs alone is given us. Now the interest is taxable. It can be shown in ITR under gross income, other sources, just like bank interest, dividend, bank deposits, and the interest on the refund of previous year in income tax returns, if any. Now, this is the yearly interest 700, 749, 801, 858 and 918 can be included in the every year. You can include proportionate to the scheme maturity displayed. The second option is on maturity. That means during the year 2023-24 to 27-28, this interest amount is not taken as gross income. So during the year of maturity, the entire interest of 4,226 is considered as interest. Number 3, it is also included as income as well as considered under 80C as reinvestment in that year. That means rupees, for example, in the first year, you are invested, your total income will go up by 700. At the same time, if you are applying under the old tax system, you can consider this 700 under deductions under 80C. So you can get the interest included, and to the extent interest is debited, it can be claimed as a interest. And the last principle is consistent basis. Now, what is consistency basis? If for earlier years, if you have not included interest as other sources of income and or deductions under 80C, for those investments, the only option available is that interest is taxable on maturity and entire income should be shown as other sources of income. And so one cannot show this in financial year 23-20. This means one should have declared this interest income earlier, or it is applicable only from the current year. Now let us see what are the changes in the old system. In the first year, as I explained earlier, in the first year, the year before, for example 25-3-2023, this is the financial year 22-20. 10,000 is invested and this 10,000 is taken as 80C deduct. In the second year, that is during the current financial year, that is during the last financial year 23-24, 700 is taken as income. You can also include 700 as deductions under 80C. In the case of 2025, it will be 749 as income, 749 as reinvest. Similarly, 801 is taken as income and 801 is also taken as reinvested. Similarly, in 27, 858 is taken as income and 858 is also taken as reinvested. In the case of last year, the 918, because the NSC is maturing on that year on 25-3-2028, 980 is added to other sources of income, but you cannot show it as deductions under 80C because it is not reinvested. In the case of new tax regime, the entire deductions under 80C has to be shown as nil, and it will not show in the e-portal also because you are going for the new tax. But in the other sources of income, you have to show rupees 700 for the financial year 23-24 as income from NSC investment, rupees 700. So your gross income will go up by 700, and if the gross income is less than 7 lakhs, no tax, it is totally exempt. Similarly, for the 5 years, it has to be, the income has to be included as 749, 801, 858, 918 like. So, in the new tax regime, you cannot claim for the investment, but at the same time, you can show it as other. The last one is on maturity basis. Suppose if you have not shown the interest during the earlier financial years, for those certificates which are maturing or which had matured in 23-24, you have to show rupees 4,026 or whatever the income as per your certificate. You have to show that in your total income under other sources. Now, how maturity amount is treated in the year of maturity, or say it has matured during the financial year 23-24, assessment year 24-25, and interest not declared as part of total income during all the previous years consistent. So, as per this approach, what happens? Let us see. This has two components. One is original investment, rupees 10,000. The accrued interest, the example we have taken, it is 4,020. Now the total matured amount is rupees 14,026. If in earlier years rupees 10,000 are actually shown as part of gross income as other sources of income, in that financial year it is fully or partially exempted but included in gross income. During the year of maturity, it should be shown as under the exempted income category, exempted income under gross income with narration as matured total investment in NSC declared as income during the investment, as total income is matched with major expenditures. The investment in NSC, if it is rupees 10 lakhs 5 years ago and during the last financial year, to be declared as exempt income for matching with expense. This means the original 10 lakhs invested 5 years ago, you should have included in the gross income. If it is not included and the relevant tax assessed, now during the current year, the entire 10 lakhs will be taken as income. Otherwise, only the interest portion of 4026 is taxable and it should be added as other income sources as part of gross income as not declared in the earlier years. Now the last date of submission of IT return for financial year 23-24 and assessment year 24-25 without penalty is 31st July 2020. Even though some may earn less than exemption limit of 2.5 lakhs or according to age 3 lakhs or 5 lakhs, yet many are not aware of TDS deducted on interest, income on NSC or bank SP or deposits, and for refund we have to submit ITR returns, and it is very simple and easy through e-photo. In case of any doubts, please feel free to write to me chirasi2u@gmail.com or Facebook Messenger. Friendly advice and not authentic and no charges in any form. Thank you very much.